Yesterday truly felt like the absolute apocalypse for stackers. The screens bled crimson, red hope evaporated, and silver did what it does when panic peaks. It punished the faithful. In mere hours, spot prices tumbled from manic highs, erasing billions in paper wealth and turning certainty into doubt. A lot of you were frozen solid, staring at the charts, your finger hovering over the dump button, asking the identical question investors ask forever: is this the end? However, today is not about fear. Today is for total clarity. While the herd watched headlines and emotions spiral, the market itself was making a firm choice. When the session opened, silver didn't continue falling into chaos. The dumping slowed down, panic lost momentum, and at one very specific price level, absolutely everything changed. That critical level was $75. Not $70, not some random midpoint. $75 became the precise line where fear exhausted itself and discipline stepped in. This was not random chance. This was structure asserting itself. This was intent. And this is the moment where inexperienced traders see disaster while professionals recognize a test. Real breakdowns don't hesitate. They slice through support with zero resistance. What we saw instead was a violent shakeout followed by a precise defense. The kind of move rigged to force weak hands out while quietly transferring ownership to the strong stackers. This is exactly how bull markets cleanse themselves without collapsing. Crashes wreck the structure. Corrections reinforce it. And what formed at $75 was not a crack in the foundation, but a deliberate confirmation that the major trend is still alive. If you grasp why $75 mattered yesterday, you begin to understand why this move is not finished. The market spoke clearly. Most people just were not listening at all. Before we go deeper, if this analysis helps you see the market clearly, support the channel by subscribing and drop a comment with a 1 if you held through the volatility or a 2 if yesterday shook you out totally. Now let's move on, because understanding this floor is the genuine key to everything that comes next. To really see why $75 held with such precision, we have to step back and look at history, not headlines. Markets have memory. Price levels aren't just numbers on a screen, they are zones where battles were fought, capital was committed, and psychology was shaped. And the $75 level carries more memory than most people realize. Rewind to the early phase of this rally. Before silver ever exploded toward the highs, it spent weeks trapped below $75. Every attempt to break higher was rejected. Sellers defended that level aggressively. Volume piled up. Frustration built. For a long time, $75 was the ceiling that refused to give way at all. Then when silver finally broke through it, everything changed. Momentum accelerated, sentiment flipped, and price left that zone behind with force. That breakout was not just a move higher, it was a regime change. And in technical markets, there is a rule that never stops working. Old resistance becomes the new support. This principle isn't theory, it is behavior. Traders who sold at $75 before the breakout regret it. Traders who bought the breakout defend it. When price returns to that level, both sides act at once. Sellers hesitate. Buyers step in. The market totally stabilizes. That's exactly what went down yesterday. The sell-off didn't stop randomly. It stopped at the scene of the breakout. The market came back to test whether that level still mattered. And when it did, it held firm. This is what professionals call a retest. Retests are not bearish, they are essential. They confirm that a move was real. Weak trends fail retests, strong trends pass them easily. While emotional traders saw a collapse from the highs, disciplined stackers saw something entirely different, price returning to a structurally important zone where large players were waiting patiently. The ones who did not chase euphoria, the ones who plan entries weeks ahead of time. This is why context matters. Without it, every pullback feels like a crash. With it, corrections become huge opportunities. And this retest at $75 was not subtle. It was aggressive fast and defended with conviction. Which tells us one thing very clearly: the market still really respects this level. But price memory alone does not build a sturdy floor. To truly understand the strength of this defense, we now have to look beneath human behavior and into the machinery that actually moves markets today. Spot price does not move on emotion alone. In modern markets, it moves on math. More than half of all transactions are executed by machines that do not feel fear, hope, or regret. They respond to predefined levels, probabilities, and statistical triggers. And yesterday, silver collided with one of those mathematical boundaries almost perfectly. This brings us to the Fibonacci retracements. Many dismiss them as superstition, but the reality is simple. Algorithms are programmed to respect these ratios. When a strong trend pulls back, the machines look for specific retracement zones where probability favors a reversal. The shallowest and most aggressive of those zones is the 23.6% level. When you measure the entire rally from its November lows to the recent peak, that 23.6% retracement sits just below $75, and yesterday's low stopped just above it, not by dollars but by cents. That detail matters. In weak markets, price blows straight through shallow retracements and searches for deeper discounts. It falls to the 38.2% or even the 50% level before buyers appear. But in dominant trends, price barely corrects at all. Demand is so strong that buyers step in at the first mathematically acceptable opportunity here. That is what we saw. The market did not allow silver to fall into deeper retracement territory. Buyers front-ran the level. They paid up to ensure execution. That behavior is not fear, it is pure urgency. The same story appears when we look at moving averages. The 20-day average, which represents the recent consensus price, sat well below yesterday's low. In a normal correction, price returns to that mean. Yesterday, it never came close. It floated way above it. This phenomenon is called front-running the mean. It happens when institutional capital is competing for exposure and refuses to wait for perfect prices. They would rather pay a premium than the risk missing the trend entirely now. When price holds above key averages and defends shallow retracements, it tells us something critical. The trend is not slowing down. It is compressing energy here. The machines saw their signals, the funds saw their models confirm, and together they reinforced the same conclusion at the same level there. $75 was not defended emotionally, it was defended quite mathematically. But math alone does not hold a market. To see how deep this floor really goes, we now have to look at the one thing that cannot be faked, the volume. Volume is the truth serum of the market. Price can be manipulated in the short term, narratives can be spun, but volume reveals intent. It tells you where real commitment exists and where it doesn't, and at $75, the volume profile tells a story that is simply impossible to ignore. Over the last several months, the heaviest concentration of trading activity sits directly in the $75 zone. This is what professionals call a high-volume node. It represents an area where millions of contracts changed hands, where positions were built, defended, and emotionally anchored. When price returns to a high-volume node, it does not move freely. It slows down here. It gets totally absorbed. That absorption is exactly what we witnessed. Selling pressure hit the $75 area and began to disappear. Not because sellers suddenly felt optimistic, but because there was nothing left to sell into. Every wave of supply was met with fresh demand. Think about the two groups trapped at this level. The traders who bought around $75 earlier in the rally watched price explode higher. When price collapsed back to their entry, they were not afraid. They were relieved. Their instinct was not to sell, but to really defend. At the same time, traders who sold or shorted near $75 months ago had been suffering. They watched price run away from them. Yesterday, the market handed them an escape. They bought to close. That is buying pressure born from pure regret. When buyers defend and sellers cover at the same level, price becomes sticky. It turns into a sponge that absorbs selling without collapsing. This is why massive sell orders can hit a high-volume node and barely move the market at all. This is not magic, it is mechanics. Regret on one side, conviction on the other, both expressing themselves through volume here. And when a market absorbs pressure instead of breaking it, signals strength. Weak markets collapse under stress. Strong markets digest it all. The defense of $75 was not quiet. It was heavy, contested, and decisive. That tells us this level is not fragile. It is reinforced by memory, by capital, and by deep emotion. But even volume does not tell the full story. Because while price was stabilizing, something critical was forming on the chart itself. A signal that traders have respected for decades now. To understand whether this was truly the end of the selling, we now have to look at the shape of the battle here. Markets leave footprints. When buyers and sellers clash, the outcome is written directly onto the chart. And yesterday, at the exact moment, silver tested the $75 floor. The price action carved one of the most recognizable reversal signals in technical analysis now. The daily chart just printed a textbook hammer candle formation. This setup is simple yet incredibly powerful to see. Price opens weak. Bears smash it down and panic spreads. Then the game changes. Buyers step up, absorb the dump, and shove price back to session highs. What's left is a long tail and a small body on top. It is undeniable visual proof of a rejection. Silver played this out perfectly. Shorts pushed hard, trying to crash the floor and start a waterfall. They failed. Every dump was met with heavier buying. By the close, the metal erased the intraday losses, sending a loud message: lower prices were denied. A hammer in no man's land means nothing. A hammer at major support means everything. When this prints at a solid floor, it signals the bears ran out of steam. They took their best shot and couldn't hold the line. The momentum indicators back up this story completely. The relative strength index never dipped into oversold zones. Instead of breaking down, it held in a bullish range. This tells us buyers bought early, refusing to wait for deeper discounts. You only see this action in strong trends. Weak markets need deep oversold signals to lure buyers. Strong markets find demand while momentum is still high. Under the hood, volume confirmed the move. Selling faded as spot hit $75 while buying volume surged on the bounce. This is textbook accumulation. Big money lets the panic burn out, then quietly steps in. When candle structure, momentum, and volume align at one level, the odds flip. The probability shifts from a breakdown to stabilization and a reversal. This wasn't a dead cat bounce, it was a hard rejection. But charts alone aren't enough. To know if this floor holds, we must see who is buying. Markets don't turn on patterns, they turn on capital flow. To find the real answer, we follow the money trail. Tracking the money takes feelings out of it. Patterns fail, opinions lie, but capital reveals the truth. At the $75 mark, the intent was obvious accumulation, not an exit. As price steadied, selling dried up while exposure returned. This divergence is key. When price holds and participation rises, ownership changes. Weak hands fold under stress. Strong hands enter on purpose. Institutions need liquidity to fill bags, and panic brings it. Yesterday's dump created the setup they want. Retail traders panic sold. The big players absorbed it patiently. You see it. Crucially, these buyers weren't gamblers. They were industrial users. Firms needing silver for production don't chase momentum. They manage supply risk. As price ripped higher, they paused. Below $76, the math made sense instantly. This is the industrial bid. When silver hits a value zone, physical demand kicks in. Factories can't wait for pretty charts. Inventory matters more than timing. Meanwhile, the commercial hedgers cut short bets. These guys usually sell into rallies. When they stop pressing, it signals the downside is capped. Investment flows leveled out. Industrial demand woke up. Commercial pressure dropped. Three forces aligned right at $75. This floor wasn't emotional, it was purely functional. But solid floors still get tested, especially when the threat is external. The next challenge has nothing to do with the metal itself. It comes straight from macro forces. We must face the risk hanging over this market because no bullish setup lives in a vacuum. Even strong structures get tested, and the biggest threat to the $75 floor isn't from silver. It comes from heavy macro pressure. Silver lives in the US dollar's shadow. When macro news hits, correlations lock and algos take over. Price action becomes mechanical, not human. Funds rebalance, models tweak, and silver moves sharply without fundamental changes. A hawkish Fed can spark a dollar rally. If that hits, silver could face another violent test, not because the floor is soft, but because cross-market flows swamp the structure. This is how sudden drops happen in strong trends. These moves often fake a breakdown. Price dips under support stops get hit. Leverage flushes and fear spikes. But without follow-through, the dip fails. They are meant to test your gut, not signal a crash. The key distinction is acceptance. Floors don't break on intraday noise. They fail when price builds value below them. Sharp probes that snap back don't kill support. They strengthen it. As long as silver holds $75, the big picture is safe. Volatility isn't a verdict, it is just a stress test of positioning. If macro headwinds fade and the dollar stalls, the path opens up. The energy stored in this chop has only one way to release. To see where that release goes, we switch from risk defense to opportunity mapping. With risks defined, we look ahead. Markets don't pay for spotting danger. They pay for knowing where price goes when the smoke clears, when a strong floor holds the next move isn't random. The first zone to reclaim is mid-range resistance above the chop. This is where trapped shorts from the breakdown will try to bail. As price climbs, their exit fuels the move. Each step up forces covering, boosting momentum. Once that clears, eyes turn to the highs. Highs aren't walls forever. They are magnets. After a shakeout, markets revisit highs faster than expected because positioning is light and conviction is high. This recovery doesn't need hype. It just needs stability. When fear dies and the downside stops threatening sideline cash returns, that flow alone drives it higher. Silver's structure supports this path. Higher lows are safe. Momentum is strong. Buyers prove they will step in early rather than wait for a crash. This builds a stair-step pattern. Sellers meet buyers higher up. The floor lifts. What started as defense turns into acceleration. But targets aren't guarantees. They are odds. The market moves in waves. Pullbacks happen. But if they stay shallow and defended, the trend lives on. Knowing this brings discipline. It stops you chasing pumps or panicking in the noise. With the map set, let's step back and learn what the market is teaching. The gap between winning and losing isn't the trade itself. It is how you handle the volatility. Every big market move teaches a lesson, and this sell-off was no different. This wasn't just a correction. It was a mind game to separate reaction from plan. How you handled it says more about your future than one trade's result. Volatility reveals character. When price crashes, fear speeds up time. Choices feel urgent. Your brain switches to survival mode. This is where traders wipe out not from being dumb, but lacking a system. Without rules, every red candle feels personal. Pros handle volatility differently. They expect it. They plan on it. They know strong trends need violence to flush leverage and reset sentiment. Without it, markets get fragile. Corrections aren't interruptions. They keep the bull run alive. The lesson from the $75 defense is patience. The market tested guts exactly when doubt peaked. Those who saw structure found opportunity. Those who felt fear became liquidity. This isn't about being right. It is about positioning. Winners don't predict every tick. They survive the shakeout without blowing up. That takes set risk respect for levels and distance from the noise. Another vital lesson is selectivity. Not every dip is a buy. Not every rally is strength. Context determines meaning. A drop into structural support during an intact trend is not the same as a breakdown from distribution. Knowing the difference is what separates stacking from gambling. Markets reward preparation, not prediction. And this episode reinforced a timeless truth. The hardest moments to hold the shiny are often the most important ones. With that understanding, we can now step back and look at the bigger picture. Not just where silver might go next, but how to navigate metal markets like this moving forward. That leads us right to the final chapter. What happened at 75 fiat dollars was more than a technical reaction. It was a lesson in how markets truly operate. Price does not move randomly. It reflects structure psychology and capital interacting under pressure. When you understand that volatility stops feeling chaotic and starts becoming information. The first strategic takeaway is simple. Strong markets do not collapse easily. They test conviction, shake loose weak hands, and intimidate participants, but they do not abandon structure without resistance. When a floor forms through multiple confirmations, it deserves respect, not blind faith. The second lesson is discipline over prediction. You do not need to call exact tops or bottoms. You need to define risk. Levels matter because they tell you where you are wrong. Without structure, every move feels dangerous. With it, uncertainty becomes truly manageable. Third, patience is a competitive advantage. Most participants fail not because they misread direction, but because they cannot tolerate discomfort. Markets are designed to punish weak hands and reward solid preparation. Corrections are not enemies of bull markets. They are the cost of participation. Upside requires volatility. There is no real reward without friction. Silver's defense at $75 revealed where true conviction lives. Your task is not to predict the future, but to align with structure and manage risk intelligently. If this analysis helped you support the channel, subscribe, like, and share. Comment 1 if you stayed disciplined, or 2 if this move taught you something truly valuable. Stay prepared, stay very patient,